Get Rich Education is brought to you by Audible. More than 150,000 audiobooks to choose from for your mobile device.
Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
Welcome to Get Rich Education Show 25. I'm your host, Keith Weinhold. This is the show where we're not into living below your means. You've only got one life to live, so why talk about living below your means when you can just as easily expand your means and live like few others can? You know, real estate investing is great at turning everyday people into wealthy people. But really, there are only a few famous real estate investors. You know, some that come to mind are Shark Tank's Barbara Corcoran, you've got Donald Trump, of course, and then there's today's guest, Rich Dad Advisor, Ken McElroy. Ken is a master syndicator today, identifying great residential apartment building opportunities and putting together other investors' money for the down payment. He knows how to identify real estate investing opportunities like few others do, and I've never known him to have a loser, not even one. Ken is disciplined, and seemingly everything he touches turns to gold. He's got the Midas touch. Well, I'm going to dig inside Ken's brain today and find out how you can get the Midas touch too. I cannot think of anyone that's contributed more to real estate investing education in this entire generation than Ken McElroy, from books to television programs to his great online video tutorials at kenflix.com, which he just launched last year. I go to these national and international real estate investor events, and you know what? The most genuine, easy to approach, fun-loving guy there is Ken McElroy. A lot of times people just aren't as gregarious and easygoing when they reach a level like he has, but Ken still is those things. I think that anyone that's in real estate investing wants to be like Ken. He shares the stage with Robert Kiyosaki and bigger names, and audiences seem to cling and listen to Ken's every word. So, hey, well, here's Ken McElroy's Get Rich Education debut. Ken McElroy has over 25 years of experience in multifamily asset and property management and development. He's the CEO of MC Companies, a full-service real estate investment and property management group. And since 1985, they've developed, built, and managed multifamily housing communities. Currently, it owns more than 8,000 units in several states like Arizona, Texas, Nevada, and Oklahoma. If you've been investing in real estate for any amount of time, you're probably already familiar with Ken. He's the author of those best-selling Rich Dad Advisor books, which you've heard of, like The ABCs of Real Estate Investing, The Advanced Guide to Real Estate Investing, The ABCs of Property Management. Ken's contributed to books with Donald Trump and Robert Kiyosaki, and Ken has really inspired people worldwide, appearing and speaking for leading industry events. He's been featured on hundreds of syndicated radio and television programs. Welcome to Get Rich Education, Ken McElroy.
Hey, Keith, thanks. Great to be on. I appreciate it.
Last month, you, I, and Robert Kiyosaki were in the same room together. I was sitting near you when Robert Kiyosaki, the top-selling financial author of all time, said right in front of us that Ken McElroy is the greatest real estate investor in the world today. That must have been an incredible, edifying moment for you.
Yeah, I've been giving him lots of money, so that is ultimately, at the end of the day, as you start to grow beyond yourself. In other words, what I mean by that, you start with your own money. That's how I started. I started with a 2-bedroom, 2-bath condo that I bought with my own savings. Then pretty soon, if you want to develop it into a career, you have to learn how to raise money, and that's where Robert and of course we have hundreds of investors like Robert come in. And then when you start to return that money back to them, then of course they become very happy. So I think we caught them on a happy day, right?
I guess so. Now, well before you were raising money, you began as a property manager yourself, right? That's the angle where you came into the business.
Yeah, it was really lucky. I was in university up in Seattle, which is where I grew up. And, my folks were not college educated, and we didn't have a lot of money, and I was on student loans and heavily in debt and, trying to get through school. And my buddy asked me if I would manage an apartment building, which came with free rent. And of course, as a starving college student, free rent is a huge incentive. So that and beer. So so I took it, and that was really when I started to learn about real estate, about business, because I was interacting with the bank, I was interacting with the owner of the building. I didn't know what the heck I was doing at all, other than I knew how to collect rent. And my dad was a contractor, so I knew how to fix things. So it's a pretty common sense business, property management. You see a lot of things over the years, that's for sure, with tenants, but it's pretty common sense. You find people that can pay the rent, and you put them in there, and the ones that can't, you don't. And then you got to get the places ready for the next person. And I really enjoyed it, and that started my whole career. And I ended up working for a big firm in Seattle right after I graduated, and had a nice 10-year run with them. And I learned how to run a property, and that gave me a huge advantage when I started to buy them.
I think that does give a tremendous advantage, because once the property has been purchased, well, then the market's already been identified, the property's already been secured, and from then on, it comes down to how sound is one's management. And what I've recommended to my listeners, Ken, is it's not mandatory to manage your own property, but it's pretty helpful. And I recommend my listeners manage for 1 to 2 years just to get the experience from the inside, and then they have a better and higher use after that. What do you think about that?
Well, I agree with you. I think the interesting thing is it's tough to manage something that you don't understand. So there are definitely people who think that property management is easy. And I'm here to tell you that it's not easy. And it's not easy at all, because you're dealing with people's homes. And as I said earlier, there's all kinds of things that go on in some of the properties that we manage still today, even. If you hire somebody to run your buildings, then you need to know the terminology. You need to know the things that they're going to ask, and you need to know the things that you're going to ask them. And there's a lot of things, small little adjustments that you can do as an owner, if you understand property management, that will make your investment do so much better than if you didn't know. And that is, of course, if you bought it correctly, which is, again, a function of property management, because property managers can help you determine whether or not you're purchasing it correctly, because my experience has been a lot of investors don't even do that.
Yeah, I know that a lot of investors, when they go look at a rental property they consider buying, they're getting more opinions and feedback from their agent, and their agent has a motivation for that prospective buyer to want to buy the building. Well, that prospective buyer needs to be talking to a property manager. An agent will tell you all day they're able to get $1,200 rent for these units, and then you talk to your property manager and they're like, maybe $950 on those. So it's important to get a manager involved early. Can you speak to that a little bit more?
It's been my experience that a lot of real estate agents and even brokers don't own real estate. They sell it for a fee. That's all they do. And so you're right, their motivations are different. Now, this is not always the case, but that's been generally my experience. And, they're trying to sell the buyer on the future. And so it's the goal of the buyer to determine whether or not all that information is correct. So in my years now, I've seen thousands and thousands of deals, and we very rarely find something that is completely accurate. When that's in the broker's package or the listing package. There's always something that is puffed up a little bit. Maybe the expenses are showing lower, or the income is showing higher, or the occupancy of the area is showing higher, or whatever it is. But that's okay. I look at that as an opportunity. I actually don't want my real estate agents and brokers that sharp, because the truth is if they knew what they were selling, they would probably buy it themselves. So, and that's when property managers come in. I think good property managers are invaluable to the purchasing process.
So it does come down to management and finding that right manager. But leading up to that, what do you look for overall when you look to put a property in your portfolio? Now you're putting properties in your portfolio that might have 100 units or 200 units in them, but I think there's probably a lot of similarities to more of our listeners that are looking to buy a four-plex or a 10-plex or whatever. So what do you look at, big picture down to small, when you're thinking, I want to put this in MC Company's portfolio?
Yeah, it's the same. That's the interesting thing. It's just more zeros. It's absolutely the same. What we look at 100 or 200 or 300 unit property is exactly the same that I did when I was buying duplexes and fourplexes. And, it's, again, back to common sense. If you're buying something out on the fringe of the city because it's cheap, you got to question whether or not the people is it going to be harder to rent or not? In some cases, it won't be that hard. But in most cases, my experiences is, people kind of live around jobs. So you want to focus your acquisitions or your buying in and around where people want to be. It's really very simple. But what happens is people tend to gravitate toward the cheaper deal. And, I'm not saying that it's not good to look at cheap deals, but what I'm saying is if you want to buy cheap and then you're expecting high performing asset, those two things don't always work hand in hand. So I think the biggest mistake people do is that they buy something and then they try to force it and they think that they can do something better than the last guy. And in many cases that can be true. But most of the time, people are buying for, what Kiyosaki and I call capital gains. So they're trying to time the market. So let's say they're sitting in a Starbucks or, maybe at a grocery store and somebody says it's a good time to buy real estate. So everybody jumps out and starts to do it. They really have no strategy. It's no different than buying a stock in a stock market. That's not a strategy. Putting money into something and hoping it goes up is not a strategy. It's gambling. So that's not at all what we do. What we're trying to do is we're trying to find assets that are in areas that people want to be. And in every city, in every country, there's areas that are good and areas that are bad. And if you can focus on areas that are good and areas that people want to be in, and not necessarily be a pioneer either, because you don't want to be the first one out there, but if you know about a redevelopment in an area, something that maybe the city's doing or the state or even a big developer or a freeway change or a bridge going somewhere or something big, attraction somewhere, those are all market changers. And those are all in the paper. So, real estate's really slow moving. If you're reading about something that's happening in a particular area, then you need to pay attention to it. And a lot of times, if you just pay attention to the things that are going on in your local market and you try to be ahead of those things, 2-3 years later, people look at you and they'll shake their heads and go, man, they were geniuses, but really it's just common sense.
Yeah, it's remarkable that in real estate, we have that advantage where you can read news stories and something slow moving, get ahead on it and actually act and tie up a property that's going to have job growth in that particular area to support the income stream of that building. If you do that in stocks, that's insider information and you could be going to jail. So
right. Yeah. It's absolute truth. That's why I like real estate. It's really dumb and it moves slow. I mean, it really does. We bought a bunch of properties in San Antonio about 4 or 5 years ago, all around the USAA, which is the financial services company for the U.S. military. We wanted to be around an area that had a lot of jobs, and they were projecting to add a lot of jobs. And those investments have done incredibly well, and I'd like to say that we're a better management company than the next guy. But the truth is, if you're a professional management company, you guys they're all pretty similar. It can change based on leadership and people. But at the end of the day, what's going to change an occupancy of a property is the demand. Do people want to be there? Is it clean? Is it run well? Is it well priced? Is it professional when you drive up to it, or does it look like crap? So all the basic things that, just put yourself in the renter's position. If you're going to bring your family into a place, which one are you going to pick? They're going to be the one with potholes in the parking lot and needs paint and the landscaping's overgrown, or is it going to be one that's, high and tight and looking good? It's so simple, but people overcomplicate it. They try to buy these places and they try to get people to, move out to the middle of town or out in the middle of nowhere. And they got 20, 30, an hour commutes, and they're wondering why they're having a tough time filling their buildings. You just don't do that. You're better off to work an area and then try to buy the best you can in that particular area. And as occupancy and employment and the demographics kind of change in a specific area, then your investment will do better.
I love how you say that real estate is kind of dumb and slow. I might not be the sharpest investor out there, but I can outdo dumb and slow any day. So, well, you talk about the market demographics, where the jobs are going, where the people are moving. Of course, that's really important. Identify your market first. Don't start with the property, which is what a lot of people do. They start with the property and then try to make the market justify the property. So to make a building most profitable, considering those things, when you buy, I actually don't think that you're looking for a 100-unit building that is fully occupied and the management has maintained it well, right? You're probably looking for some opportunity. You're looking for some meat on the bone for yourself. Can you talk about how you add value to a building?
If you run out of money and you start to ask your friends and family or your investment network or whoever you're involved with, to invest in something, one of the things that they're going to want to know is, when do I get my money back? Back to when you started with Robert, that's the game. If you're borrowing somebody's money, OPM, other people's money, and you're going to invest it for them, then you need to make sure you have a good exit. And so if you're buying something that is 100% occupied, being run really well, and the rents are at the top of the market, again, back to my other strategy, that is not a good strategy. That's gambling. That's hoping that the rents will be higher next year. You're buying something that looks good on paper, but doesn't necessarily add value. So this is where the management comes in again. For example, I would actually be much more willing to buy 100% vacant four-plex in a good market than one that's fully full.
Right.
Because it just makes sense, right? Like, which one's going to be more money? The one that's full, of course, right? So the one that's vacant. And how long does it take me to rent 4 units? Less than 30 days. So that's how you create value. It's the same with a commercial building. If there's a building that's 100% vacant, a commercial building on some corner, and you have figured out somebody who wants to lease it, you go tie up the building, and then you put the person in it, and it's worth more money. When people start paying rent, the real estate's worth more money. So if you can buy it and you have the confidence and the team behind you to be able to take something that's low performing and change it, then you've created value for your investors. And that's how you create value. You buy something for $100,000, $200,000, $300,000, and you fill it up with good people that can pay rent and service the debt, on the mortgage, pay the expenses and all that, and give some cash flow. It's going to be worth more money after you fix it. So you want to buy things that are broken and fix them. You don't want to buy things that are fixed.
Yeah, we're going to talk a little bit more about adding value to a property after we come back here with Rich Dad Advisor Ken McElroy. I'm your host, Keith Weinhold. Get Rich Education listeners, how would you like the latest audiobook from Robert Kiyosaki, the #1 personal financial author of all time, for free? For my listeners, Audible is offering a free audiobook download with a free 30-day trial to give you the opportunity to check out their service. You can pick out any audiobook that you want. My pick is you really ought to read Robert Kiyosaki's new book, Second Chance, For Your Money and Your Life. It uses the lessons from the past and a brutal assessment of the present to prepare listeners to see and seize the future. Get yours now at audibletrial.com/getricheducation.
This is Rich Dad Advisor Garrett Sutton. To grow your wealth, listen to the always valuable Get Rich Education.
Welcome back to Get Rich Education with our guest, Rich Dad Advisor Ken McElroy. So, Ken, what are some other examples, maybe some recent ones you've had, concrete, actionable examples of how you've added value to a property?
Sure. Well, the most obvious one is to find something that is under-managed, under-rented. So, how does that add value? So, for example, if something's 50% vacant, which I've bought stuff like that, or something that is poorly managed and in a market that's really strong, those are really, really good deals if you can find them. Because, in fact, we're buying one right now in Houston, Texas, where we believe that the rents are $200 higher per month than the competition. So when you find something like that, that's huge value. It's a 300-unit property. So you can imagine how much more rent that property can sustain once we do that. Now, it does take a couple of years to get to that point, but those are ways to add value. On some of the older properties, my experience has been that you got to go to what does the tenant need? What does the tenant want? There's a number of things that we've done. We've charged back the utilities. So, for example, we've found properties that I'm actually in escrow right now on some property in Tucson where the current owner has never charged back the utilities. So, in other words, the tenants are not paying any water, sewer, trash at all. And so we're going to buy that property, and then we're going to start to bill that back to them, which is kind of a normal thing in the industry. So these are all small little adjustments, but $30, $40 a month can be a substantial thing when it comes to value. There's a bunch of things like washer and dryers are a big one that we've done. I've probably done, I don't know exactly, 3,000-4,000 washer and dryers. So what that means is you find a property that has the hookups, has a laundry room on site, or doesn't even, but has the hookups. And so you merely just buy washers and dryers and put them in the units that you buy. So, for example, we can buy a set of washers and dryer for about $500. You can charge anywhere from 25 to 50 more per month for that, because those people they're carrying all their laundry down to a laundry facility somewhere, and they're paying $2 a load somewhere. And so they're already paying it. So what you're doing is you're providing a convenience and you're increasing their rent at the same time. So those kinds of things. And, we've done that with adding carports. We've done that. A lot of people, especially in our senior communities, have pets. We have a real solid pet policy that allows people to actually have their pets. Well, people will pay money for their pets. And by the way, they should, because some pets are, not all pets are equal. So we have places for that. We charge extra rent for pets, not just deposits. And so there's just a number of things when it comes to what we call other income that we do, before we buy a property. And that's probably the biggest thing, Keith, for a takeaway for your listeners, is we identify all this stuff before we buy them. So this is not something that we're trying to do after and we're trying to figure it out. Everything that we close on, everything that we buy, we know exactly. We have a full plan on the rents and on the other income and on the expenses and on the mortgage and on the debt before we close. We know within a very small variance of exactly what we think we're going to do to increase the value of the property. So this is not something that you fall into and then try different things. I mean, this is all vetted out through the process of what we call due diligence before we buy anything. So we spend a lot of time finding what I call the golden nuggets of value inside of any property before we actually buy it.
And as part of your due diligence in identifying what might be a great value-add building, since billing back utilities to tenants that are not currently paying for utilities in their building, how exactly do you go through transitioning that? Do you grandfather in the tenants that were having their utilities paid for them and then slowly turn them over as new tenants come in?
Great question. Yes, very good question. Yeah, we do. We come up with a policy, and you'll find that people are used to paying utilities. So what happens is you have a bunch of landlords, especially in the smaller stuff, that never charge it. For example, if you're buying a single-family house, the tenant usually pays utilities, all the utilities. Yeah. The owner's not going to pay the sewer and water and trash. So four-plex or eight-plex, sometimes the owner's actually paying for those. So what we do, well, there's a couple things you could do. The first thing is if you have a vacancy, then you write it into the lease for the new ones. So it's something that could happen over a period of time. And then, as you know, in the apartment world or in the duplexes or fourplexes, most of these leases are 1 year. So you do have the ability, as you consider renewing these people, that you can increase their rent through adding utilities. So they adding utility expenses, or, as a chargeback. But you have to be careful too. You want to. It's a fine balance between having somebody move out because they're pissed off that you're charging back utilities and increasing their rent at the same time, because you're transferring an expense back to the tenant. You're actually not eliminating the expense. What you're doing is you're offsetting it with income.
So when you go and you do your due diligence on a deal, there's got to be some point where it breaks even or where it exceeds or where it's diminished to have your own on-site property management versus using a manager that's off the site. I mean, how many units do you need in a building where you have management on-site? And then what are the advantages of having on-site management versus off-site management?
It's a great question. It's tougher to manage smaller buildings because you have folks that are driving around and basically dealing with problems. So if they've got an issue at one of the buildings, the property manager is going to drive over there, and they may or may not get by there for days or weeks or even months at a time. Whereas the larger properties, have a whole staff, which is part of the reason why I gravitated to the large properties. Even though I started with a 2-bedroom condo, I was managing it myself. I was communicating with the tenant. I was figuring out how to find a lease and do all that. I was figuring it out all myself. Luckily, I had a background in management. But it can be a pain in the butt, especially if you're working, and the last thing you want to do is be married to a piece of real estate, on a weekend or in the evening. So that's why I like the bigger stuff. And as you start to get, up over 15, 20 units, you're going to start having more demands just because of the number of people living there. And as a rule of thumb, it takes about one admin person and one maintenance person per every 100 units. So, for example, a 200 unit property could have a staff of 4 or it could have a staff of 5. But I like that because, I think we have close to 300 employees right now. 250 of them are out on the properties. And so, there's a whole system of training maintenance people and trying to do everything in-house and saving money and ordering and putting the right people in the units and making sure we're compliant in, a number of areas. So I think that the larger properties are easier, but I totally get the fact that it's a process. You can't just jump from no units to 100 or 200 unit building. It's like anything, you learn over time and you start to gain a little more confidence, and then you start to look for bigger stuff.
So you must have a lot of competition for these deals, and yet you land a lot of these big real estate acquisitions. So how do you match up against the competition and make sure that your offer is accepted, not theirs?
Yeah, well, it doesn't always work. I mean, even though we have an incredible track record, at the end of the day, like we talked about earlier, these brokers, they want the biggest commission, and the seller wants to sell it for the highest price. So the first thing is we never really vary from our model that, we're number one, we're trying to return our investor equity back. So what's the best way to buy and return our investor equity back? And so that kind of determines whether or not we even make an offer. So there's just a bunch of hot money in the market right now. And unfortunately, hot money pushes the price of real estate up, and which also, of course, pushes the cash flow down. So we were very successful buying a lot of stuff when the market was, say, flat from 2008, through about 2012, maybe 2013. And the last couple of years have been hard. Have been a lot harder. It's not unusual for us to have 20 to 40 offers on a property. And, out of that, let's say 20 offers, there's 10 groups that are qualified just like us. So it's gotten very, very competitive. And at the end of the day, the broker and the seller are going to pick it's not necessarily always about price, but they're going to weigh price with the group that has the most experience, which includes track record and what they've done to evaluate the property. So if you've just made an offer on something without visiting it or without doing a lot of homework, and they're asking you questions, on how you're going to close, and you haven't met with a bank, and you haven't met with a property manager, and you really haven't done much due diligence because you haven't had time, you're probably not going to be able to close. And so we were overly aggressive on our due diligence process. So after we get a deal in escrow, we can go through due diligence in a very, very quick period of time. For example, we're in escrow right now on a 8-property portfolio deal in Tucson. It's 1,576 units. And we did the entire due diligence in 15 days, and we walked all 1,576 units in 3 days, which is some part of what we do. And so fine-tuning your systems, it brings seller confidence and broker confidence, and communicating those kinds of things that you're doing kind of behind the scenes as you're trying to close is very, very important as part of the selection process.
Yeah, I'm sure at this point you have a name that might almost precede your offer. Everyone's heard of Ken McElroy in real estate, but it wasn't always that way.
Yeah, right. And so when you first start, you're like I was, nobody knew who the heck I was, and I just knew that this is a business that I wanted to be in. And you start to build your team, you start to close 1, and then you close 2, and then you close 3. And all of a sudden, the brokers get to know you. It's like anything else. You're not going to go from 0 to 60 just because you want to. It is a process. And I think it's a very good process, too, because you're learning. Each project, I learn so much on what I'm doing. So I love the business. I think it's great. It can give people the ultimate freedom. They just use common sense and buy properties where people want to be. And it can be a very rewarding career that gives you an amazing amount of freedom and time. Even though I'm busy, we have 2,000 units in escrow, over $100 million worth in escrow. I take all of June off. I take all of July off. I don't come in the office. I don't work because I have the cash flow coming in on everything that we bought, and I have a team around me. And I'm telling you, if I can do it, anybody can do it. I started with a 2-bedroom, 2-bath condo. So it takes a while. It's a very rewarding, great business.
I love hearing about that. I'm so glad you brought that up. It's about your return on time invested ultimately. So I love to hear that you have a great lifestyle and you're able to take time to do the things that you want to do. Now, I know a lot of my listeners would love to be Ken McElroy someday. In fact, I guess I need to admit, maybe I would too. I mean, a 50-unit building in Texas is really the first property I was really capable of buying as far as what the largest one was. So let me ask you an insightful question, Ken. If you could look back and if you could give a phone call to your 20-year-old self and provide that 20-year-old Ken McElroy with some advice, what would you tell him?
Well, this is a timely question because my son's 17 years old, and I actually just had this conversation with him. He was in his English class. The teacher handed out an assignment, and she said, "Okay, I want you all to work on this assignment." And he raised his hand and said, "Can we work on it as a group?" And she said, "No, you can't. That'd be cheating." and he said, "Well, isn't that collaboration?" And she's like, she kind of bit her tongue, and I said, "Oh, Kyle, did you get in trouble for that one?" He said, "A little bit." But that's actually the point I'm trying to make, is when I got out of university, I believe the school system does set you up to be very individual. The mistake I made as a young man was coming out thinking I needed to do everything myself. It's so much better, I've learned now. And that's why I love being part of a Rich Dad Advisor team. Is we sit around and we really do brainstorm. We read books together. We talk about stuff that we're working on. We're completely vulnerable to each other on things that are going well and not well. Most people don't do that. Most people are afraid to admit, that things are going wrong, and, they only boast about what they're doing is right. And sometimes they boast about that even when it's not. So I think coming out as a young man, I would have definitely sought more advice from mentors and people that I looked up to, whether that, that could be relationship, it could be working out, it could be speaking in public, it could be writing a book, it could be, buying real estate. And I just wish I would have done that earlier as a young man, because I ended up doing that, but I ended up doing that in my 30s. That changed my life, because there's a lot of people out there that are willing for free. They'll set you on the right course. And I still meet with a mentor. I've been meeting with him for 15 years. I meet with him once a month. We talk about a number of things. And once I started to do that, my life changed.
Well, that's really valuable. Hey, this has all been good stuff, Ken. How can my listeners find out more about you?
Well, my website is MC Companies. That's our main company website, MCCOMPANIES, if you want to see about something that we're doing on our company. My personal website is kenmcelroy.com. That's KenMcElroy.com. And we have inside of there a series of videos that we do. I've been answering these questions. There's a lot of same questions that you asked, Keith. I've been putting them into video form because I think a lot of people like to see the videos. And so we created a whole website called KenFlix. That's KenFilx. That's been a great forum for me to be able to get emails from people and then actually go find the person or do it myself and put these into very short videos, these 3 to 7 minute videos that people can watch. We have hundreds of them up on the website right now, and on a number of questions, from due diligence to how to find a property to what kind of systems do we use. And we brought in our head of management, Leslie Bryce. We brought in our head of our construction, our acquisition guy, or the guy that runs all our investors. A lot of different people been doing videos for KenFlix. And in fact, I even have Kim Kiyosaki just go up and do a bunch of videos, and hers will go up very soon on some thoughts that she had. So I'm very excited about that, because it gives people a really a nice format to be able to go and learn at their own pace.
Yeah, that sounds like a great asset to users. Hey, thanks so much for stopping by on Get Rich Education, Ken.
It's my pleasure, Keith. Thank you.
I'm grateful that Ken McElroy and I could get on the same schedule so that I could bring him to you today, but I'm equally grateful for your listenership. Off microphone, Ken let me know that they currently have about 2,000 rental units in escrow, and that they ought to grow MC Company's portfolio from 8,000 units to 10,000 units by the end of May. Boy, I think that when a real estate investor daydreams, they think about owning a portfolio like Ken McElroy has. To Get Rich Education Nation, don't quit your daydream.
You've been listening to the Get Rich Education Podcast, telling you what the wealthy won't tell you about real estate and investing. If you enjoyed the show, please take a minute to visit iTunes and leave your comments.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.